Sure. Yeah. Thanks for having me, Will. So look, I mean, if indeed, right, VIX is back down to now levels last seen in 2020 pre-COVID. We have to really see where we're coming from, right? In the end of October, we're at VIX above 20. And since then, we've put a lot of risks behind us, right? Particularly macro risks like rates have come down dramatically lower. And this all started with the Treasury refunding announcement and then the Fed meeting, the non-farm payroll, more recently the CPI. And all of them actually came out, pretty bullish for equities. And with these events behind us, there is a lot less risk in the market, a lot less risk for the market, a lot less demand for hedges, and therefore a lot less demand for options and lower prices for options, lower implied volatility, lower VIX, right? And right here, particularly now that we don't even have earnings between now and year end, most just all the S&P 500 earnings are virtually behind us right now, and particularly after what we've heard today from Governor Waller hinting at potential consideration for rate cuts next year, and with the last macro risk really between now and year end being really the Fed meeting that is pretty well telegraphed. Or at least a wide majority of the street, is expecting a Fed to stay put and just to remain data dependent. And between now and December 8, we have really no macro event to speak of with the NFP on December 8, and then. Of course, there's going to be CPI right before the Fed, but ultimately there is not that much risk left between now and year end.